Hey everyone, this is Rob Keens from goldsilverpros.com. It is Wednesday, April 28, 2021. I have an extremely special program for you today because we're going to talk silver, and more silver. A lot of you guys have been wanting me to do this lately, and so we're going to dedicate a program entirely to it. Now, I'm going to talk about some things that I talked about in the Cowboys Metal live stream that we did Sunday. We have every Sunday, 1 p.m. Central Standard Time, when I was broadcasting from DC, and we covered the May Day Massacre, which is basically we're coming up on the 10-year anniversary of that. And that is the 10-year anniversary of the silver price falling from touching on its all-time high, the $49 to $50 range. We're going to talk about that. But I've got some other very special information for you in this presentation. I don't think that you're going to want to miss it because I'm going to cover a lot of ground here. I'm going to give you some of the view on silver from officialdom, and then we're going to look at some legalities and things like that that I think is very important. I think that there is some potential misinformation there floating around, and I think some of it just stems from different viewpoints on the market and different viewpoints on why the market exists. And that's getting to that fundamental perspective is really what I want to do. But we're going to start looking at the silver price. And as promised, several people have emailed me and asked about this on comments on other shows. We're going to look at open interest and the May contract as well. Note that we covered this. I covered silver and gold a lot last night on the Miles Franklin channel. You can see that video if you go to Miles Franklin on YouTube. Look at their latest video. That one's trending up. I think it had 11,000 views. Last time I looked at it, we may get to 15,000 in a day, which is really good. And I also on Friday will be on Dunnigan Kaiser show on Liberty and Finance on an all-star silver panel. Please stay tuned for that one. We believe that's going to be released Friday, just in time for May 1st, which would be the following Saturday. And then stay tuned to this channel because on Saturday, we're going to do a broadcast during May Day, and we're going to talk news and all things silver on the big day. But let's jump right into the charting real quick because that's what you guys have been asking for. So we're looking here at a 100-year historical chart of macro trends. One of the reasons I wanted to start with a long-term chart is because depending on how you look at silver is your perception of where silver could go from a price perspective. And I think also the way that you look at a chart can influence how you see it. So I'm going to make that point here by just looking at a regular non-inflation adjusted chart of silver. We can see that as it was, money in the financial system per the U.S. Constitution, we had silver in our money up until the point at which it was released from that obligation. It started rising, and then we reached a high here in about January of 1980. We can get to focus on that 35.75. That's non-inflation adjusted. So then if you look at the next rise in silver during 2011 when it hit, let's get that price there, 48.60. I think it really touched on almost 50, a little bit above that on some other information I looked at. We'll just call it 49. It reached what looks like a much bigger high, but that's not inflation adjusted. So if you take CPI index and you apply that to this chart, it changes quite a bit. So, and that matters because gold and silver are really the measure of inflation, especially gold, but silver to some extent as well. That's why they were money, because when you have them in a system which is non-fiat, they retain more and more value over time. They slowly appreciate in value. When you have a fiat system, the fiat dollars are printed more. Those prices for those metals should go up, and we should expect a pretty high price rise. So if we're looking at this, you're saying, well, it's peaked a couple of times, but somewhere in this range is probably the real price of silver if we looked at CPI. Well, let's click the inflation adjusted chart and see what happens when we add in that CPI data. Now, before I do that, just to remind you, I don't believe CPI data is actually correct for reasons that I state in my book. If you go to my website and subscribe, you can get a copy of that book. Chapter 2 has 50 pages where I use government data to examine government statistics and challenge inflation and many other things. I'll just suffice it to say I don't believe the CPI numbers for very good reasons, but we're going to use them here because it's on the chart. So if we hit that adjusted for inflation, notice everything changes. I'm going to take that off. And it looks like the all-time high was actually in 2011 and not in 1980. But if you inflation adjust it, then you see a much different picture. Inflation adjusted just using the CPI, not what I think is real price inflation, real world, but the modified government inflation, silver touched up over $120 in today's money. That means the value of money significantly has declined against the price of silver. silver came down and was trading below $20 for a longest time, even though money supply was being printed. And then we had a spike in money supply last year due to the pandemic. I've showed the M1, the M0, the M2 charts on my videos many times. We just showed it earlier when we were talking to Sailfish and we were talking about oncoming inflation earlier this week and gold royalty companies. We talked about inflation. I showed the M1 chart and I showed the hockey stick move in 2020, where we had printed so much money, the M1 measure of that liquidity of money. And then it literally in 2020 last year went vertical as the government printed a whole lot more. And if you average that in, silver's price as a result should be much higher than it is. But as we see inflation adjusted, it's nowhere near where it was in 1980. Inflation adjusted today's dollars in 2011 is 57.25. So the nominal amount was 49 bucks, but we've inflated away an extra $8 per ounce of silver. This is how you read that between 2011 and now, a value. If when we've inflated away, if you look at that $125 price, I believe it is what it was, 121.73. We've inflated away a lot more than that. This is where silver should be at least in 1980 terms, in terms of inflation. And we're not talking about scarcity or the additional uses of silver, the additional demand, industrial demand and investment demand that's occurred. So it should be really, the price of silver should be a lot higher. So depending on the way you look at the chart is where you can sort of set your price targets if you believe in a true free market. And we're going to get into that true free market here in the program. Now, I could spend a lot of time talking about this. I'm going to move through this stuff fairly quick because we're going to come back, like I said, on Saturday, talk about this more during May Day. I'm going to give you some more data. We're going to talk about some news stories and things. So we're going to move fairly quickly. But I've got the silver chart up here. I've got the shorter term chart. It is about the 3-year chart, give or take. And I really want to focus on what's been happening since March of last year when silver started its move. It was trading about 11 bucks, 12 bucks. And it popped up to about 29, almost 50. You can see here, just above 29. It was going to get to that $30 line. You see this red line right here at the top? That's that $30 key key resistance line in the silver market because it has not wanted to bump up against that for a long time. If we take the inflation adjusted away and just look at nominal prices, the last time it was up at $30 was really in the 1980s. And then it hit it again in about 2010, 2011 during the run up. So that $30 is rare in silver and it is a key resistance line. So it's bumped up against it a couple of times. You can see here on the chart, bumped up against it August of last year, bumped up against it January, right after the presidential elections. There was a nice low bump here that I've covered on my channel a lot, this uptrend you can see outlined in these blue lines. And then it came down. Here's a little bull flag pattern. And then it popped back through the bull flag pattern and back through the 50-day moving average, which is this blue squiggly line right here, 50-day moving average. But the bigger trend is this big flag pattern. If you see since last August, it's bumped up against this key $29.50, $30 mark. But on the bottom, it's been rising. It's been this positive momentum. And I've got 2 of these here. If you look back since March, we have this really wide open flag. But even if we go forward a few months to July, we still have a really sharp flag of where silver is trading. That's a consolidation pattern, meaning the market is battling in this range. At some point, it's going to break out. That is a positive bullish signal. Now, just because we see this on technical charts doesn't mean it's going to happen in the future. It's not predicting the future. But as I was telling one of my subscribers who wrote me today about technical charting, it can, when you combine it with fundamental analysis, it can give you clues as to where the market wants to go. Because we're looking at a collection of millions of decisions around that silver in the futures market to determine that price level. And that can give you clues where it goes in the future when you combine that with fundamental analysis. And we'll talk more about that later on. I've talked about that in the past. In any case, there is a bullish signal here on silver. And remember, on the long-term chart, inflation adjusted, we've got a long way to run. And you know, there are a lot of things we could talk about here, but just using CPI, which is like the lowest level of any inflation anybody could agree on, and most people who are rational agree that CPI is understated, and know it is when you look at the government statistics and how they calculate them since 1980. We've got a long way to run, but it looks like in the short term, technically, it looks like we're getting this positive flag pattern that looks like it's going to pop silver up. So that is sort of the technical analysis and the price analysis. We're going to get into the futures. That's what people want me to do. As of right now, you know, it's early afternoon here. We're trading about 26.10 or so on the COMEX chart. It's down about, 1%, about 31 cents. Not a huge move on the day. Overall open interest is up leading into May, the contract month of May. Right now, overall 115,000 contracts, futures contracts, although they're not actually in May. A lot of that is rolled off. You see today, 17,000 contracts, actually as of yesterday. Well, that's actually, yeah, yesterday's data, Tuesday the 27th. We saw a lot of contracts roll off. I think the day before is like 11,000. Let me go back and do Monday's data. Oh, sorry, 14,000. So in 2 days, you've seen negative 31,000 contracts come off of this May contract and move into July, June, some of these other contracts. And this is natural. The contracts roll because it's a futures market. And what people are doing is hedging their various positions in the market on a forward basis in order to address their exposure to silver. Because remember, this is a derivative market. It's a derivative market, and therefore it's not the physical market. So people will roll their future positions overall, and that does affect the overall price. And that's why we say this is a paper price driven market, not a physical. We're going to look at physical here in just a moment, and we'll get into what the physical is actually telling us. So over here, open interest is falling. It's building up in the July contract. There's still enough open interest. Let's get back to the Tuesday data. I went back to Friday. There's still enough open interest to have a sizable amount of deliveries in May, but I don't think it's going to be what we thought it was going to be originally before. However, just because there's not a lot of open interest doesn't mean you can't have some healthy deliveries. And I think the deliveries are coming on the retail side, not the industrial side anyway. And that's what we're going to spend some time talking about as we move forward in this presentation. That, you know, the incremental demand and the whale in this market is actually retail demand, not industrial. David Morgan has been on my channel saying that many times, a silver guru. I agree with him. It's the incremental investment demand which really moves the price of silver over time. And the fact that the whale of all these people getting interested in silver in the retail trade could be much bigger potentially than what we see in the industrial trade. And I'm going to prove that by showing you some data about what happened earlier this year. We'll get into that. Anyway, that is where we are in the open interest and where we are potentially with the deliveries. 14 deliveries there on Tuesday's data. On Monday's data, we had 18 deliveries. We had a little bit EFPs, 95 there on Monday, Tuesday. We had 192. So a lot of arbitrage between the COMEX and London through that exchange for physical mechanism, EFP right here. If you guys need to know more about EFP, look at my Cowboy Metals live stream from a week and a half ago, and I go over what EFP means that way. That's the reason I'm not going to explain it in detail here. Now I want to go over deliveries. So this is the deliveries for silver futures printed as of 4/27 from the CME's website on the silver contract. So we've had, you know, a fair amount up to 29.87 total from the first notice date of March 31st to the last date that they have the data here, 4/27/2021. I just loaded this sheet here about 20 minutes ago. So this is the latest and greatest. Now the deliveries aren't going to just blow you away, but I suspect in May they'll be higher because you have higher overall open interest here. I don't know if we're going to get 80 million ounces delivered in May, but we should get a fair amount delivered on the COMEX. But we're going to look at some other things here in a moment of where the deliveries could come from. Now I wanted to take you to gold charts or us, because really in the title of this video, we're talking about silver coming off of COMEX. And this is big. What I've explained many, many videos before is that since 2000, you saw this amazing buildup of silver on the COMEX. And they created basically the eligible stocks, meaning all of this prior to that could have been considered for delivery, or it could have been storage, but it was all lumped into the same thing. Then they physically separated on their accounting the eligible and the registered stocks, meaning eligible is just vault storage, no warrants or receipts or anything attached to that metal where it could go for delivery for futures contract. So they created the separate basic categories of registered and eligible. Registered is what could go to a futures trade. Eligible is what's just sitting there in storage. And for the longest time, silver was building. You see the same thing in gold. So there are record amounts of silver and gold on the COMEX, and people said healthy, you know, stocks, not a problem. Well, the CME group came out April 9th last year, a year ago, and basically stated that they think there's a 50% haircut here in what eligible could be used as deliveries. And the reason they said that, and they said, well, it could actually change. We don't actually know what it is, because all this light green here, this is just storage. You can't force that on the market. It's privately owned. So really, when we want to know how much silver could go against a contract, we're looking at this green. And notice there is at times when this got really thin. When we look at 2016, there was a little bit of spike in silver price. This got really thin. And then it boosted up quite a bit. A lot a lot of the reason why silver stocks have come into COMEX is because of that EFP trade. Because if there's a big difference between the price of the future and then the spot contract in London, it can pull silver from London and even from the refineries in Switzerland onto the COMEX. And that's why a lot of the buildup came. Of course, we also saw JP Morgan in July of last year, and I documented this last year in my videos, took 30 million ounces from their, the light green eligible category and put it into registered. So those two combined things, the EFP action price arbitrage, which actually pulled silver over to the US from London and from Switzerland refineries, and JP Morgan saying, well, we've got 30 million ounces sitting on the COMEX, but it's in private storage. We're going to put it registered eligible. That provided the liquidity we now have. Now, the astounding thing is you see this huge drop off. So this is the first big drop off we've had in silver since that 2016 time period where you had a nice price, and since that 2006 to 2010 time period where you had the lull in the precious metals market before the financial crisis. This is the biggest reduction of overall stocks in the registered category since then. And it's the biggest overall reduction overall when you consider eligible and registered since you go back to like the 1996 to 1997, 98 timeframe when you had a lot fall off. So we've had more deliveries as of late than we've had dating back about 24, 25 years when considered in total across both categories. So that's pretty astounding. We're going to go to a shorter term chart and we're going to show you what it looks like. Let's see if we can get this on the 3-month chart. You can see that we had about 400 million ounces when you combine eligible and registered on the COMEX. Now, most of those weren't for delivery, only the registered were, but the eligible, maybe you could have coaxed some of that out if you paid on a high enough price, but that was 400 million. Now in the span since February, since we had that run in SLV, really till about here. It was the end of February after, the SilverSqueeze movement, money rushes in SLV, pulls a lot of the silver out of the OTC market in London, and puts it into SLV's coffer where they store in those depositories over there. Since then, we've seen about a 40 million ounce withdrawal net when considered both registered and eligible off of the COMEX depository. And most of that has actually been in registered. You see this going down much more than you see the eligible category going down. So a lot of it is what's available for trading is coming off, but combined about 39 or so million ounces, 40 million ounces, somewhere in there. That's a lot. And that's the biggest net since that 1996. If you go to that long-term chart, since about 1996, when overall inventories fell. Remember, since about 2000, when they created this eligible, is basically the overall stocks have basically gone up with a little blip there in 2011, right after the financial crisis, people taking delivery. So this is the biggest short-term move since we had in 25 years. And overall, it's beginning to rival. If you look there, about 150 million ounces to about 100, it's about the same as what we saw from about 2008 to about 2011. And we're not even in a financial crisis. Okay, so we're not in a financial crisis, but we're seeing silver pulled off. I wanted to make the point that that's a lot. So we're now sitting at 360 million ounces as calculated here at Gold Charts RS, Nick Laird's site, a pay site, not affiliated with them, but I pay for it because I love the information. Highly encourage you to do so, to subscribe if you want. So all of that, coming off, again, we were at 400 million not long ago in this big move. The next big move was 2016 and then the financial crisis. So again, big moves. We haven't had that in a long time. That's a trend to pay attention to. All right. So the next thing that we want to talk about is, where did that silver go? Did it, because of the lowering EFP rates, or the difference between the price of silver on the futures and the London spot, COMEX in London, did it all go back to London? That's very difficult. So if you look at London stocks have gone up quite a bit. This is troy ounces in thousands. So it's gone up, it looks like to me, about 120 million ounces have come into the Lbma vault. This is Lbma vault holdings data. This is silver. From February to March, about another 120 million came in. Now, a lot of this is refinement. A lot of this is as the silver companies have recovered and started producing a lot more silver, it flowed back into the OTC market. It flowed back into vault storage in London. Not all of this, by the way, is available in the OTC market. It's just a net of what's sitting in their vaults. A lot of this is claimed by the exchange traded products, the ETF funds and stuff like that. It doesn't mean it's liquid silver. So a lot of this reflects the increased demand in the exchange traded products, the ETFs, and not necessarily what came from COMEX. Net, if you look at all the silver that's gone into the exchange traded funds and what's come out of COMEX, it doesn't match. So we believe that some has been taken off of COMEX and just staying off of COMEX And that's a big thing when you're pulling metal off the market. And that's the trend for you. And a lot of this buildup is the increased demand in those exchange traded products, exchange traded funds, and then also some private storage as well. Not all of it available to the OTC market, and certainly not all of it from COMEX. We've documented that in previous videos, some of those flows. I'm just summarizing that here. Go back and look at my previous videos for more on that. Next thing I wanted to do is look at silver deliveries. So leading up to May, this is deliveries right here. So we saw in 2019, a decent amount. And then, of course, in July of last year in 2020, based upon the increased deliveries I saw, I called the silver pop where it really started to move, and it moved quite a bit. I called it 2 or 3 days ahead of time when that price move happened. And then we haven't had that action like we had in July before, but we've had more consistent heavy deliveries. If you look at this range right here from about August to about now, the amount of silver deliveries that have occurred on COMEX overall, and that could just be from one participant to another, but it stays on the exchange, has increased. So net, we've had more overall deliveries against a futures contract than we've had in quite some time if you look at the chart. And if you go to like a long-term chart, let's do a 5-year chart, you can really see it. You can see since 2020, a lot more silver has been delivered. And when you add it to this chart, a lot more is being taken off. So it's not just passing from one participant to another and going into eligible vault storage. It's actually being pulled off the COMEX. And some of it's trading hands on the COMEX, but a lot of it's being pulled off the COMEX. And I think that we have described that there for you. So we've gone over all of that. The next chart I wanted to tell you, or the actual paper, is a Silver Investment Report 2021 on the Lbma. There's a lot to go over here, so I'm going to try to do that quickly. This appeared on the Lbma's website not too long ago. Here is the URL if you want it. We'll try to post this down to the description. It's on the Miles Franklin video I did yesterday. Elijah put that on there for us. But we want to go through some things, and I'm going to start down here a little bit. We're going to start at principal ETPs. So we're going to explain a little bit about what an exchange traded product is. So we'll start right here. We're going to read these 2 paragraphs. At present, there are some 20 physically backed silver ETPs. In this section, we look at the largest products and the key issuers by location. The location often differs from where the silver is located or stored. I'm sorry. For example, while the U.S. is by far the largest market by silver ETP issuer, the UK comfortably dominates the physical storage. And that's important. Listen to the next paragraph. The largest ETP by some distance is US iShares Silver Trust. That's the SLV ETF. Launched in April 2006, and with 575 million ounces of trust as of the end of March, this fund accumulated or accounted for half of the global silver ETP holdings. It is one of the 3 products that are listed on the New York Stock Exchange ARCA. The other 2 are Aberdeen Standard products. So SLV dominates. And a lot of the ETPs and the ETF funds and stuff store it in the London market. Pay attention to that as we get further through the paper. So we're going to go down here. We're going to skip past ETP custodians. I've talked about custodians before, but I want to talk about something that they very interestingly put in this paper. And this is the paper I talked about on Sunday, but because I was doing a live where I was walking around, I didn't actually walk you through this on video to show you what it is. So I'm going to walk you through some key pieces here. So they talk about the social media storm. But before we get to that, there's an amazing thing here under the implications for another surge in ETP demand. So it says here, global ETP holdings hit a record high of 1.207 million ounces on February 2nd, 2021. I'm sorry, 1,207. That's 1 billion. As impressive as it may appear, it does not tell the whole story. As the social media frenzy gathered pace in late January, they're talking about the SilverSqueeze movement here. Demand for coins, bars, and ETPs all jumped. For the latter, the ETPs, global holdings surged by 119 million ounces in just 3 days. Now, remember, 110 million of that went into SLV on the last business day of January and the first 2 business days of February. We documented that. This was concentrated in the iShares fund, like they say here, which holdings rose by 110 million ounces. That's what we've said. Given that most of this metal was allocated in London, fears emerged as to whether there was enough silver should demand continue at this pace. Now, pay attention to that. It says the most of this metal is allocated. Once it goes into SLV, it's allocated to SLV, meaning SLV, quote unquote, owns it. They've got their name on it, okay? That means it comes out of the OTC or the unallocated market. The unallocated market being paper derivative exposure to a limited number of ounces, multiple potential owners. So once you convert, in other words, unallocated ounces or ounces supporting the unallocated market into allocated, like the SLV, it affects the rest of all the other trade on the London OT market. Pay attention to what I just said as we go through this. So this is going to be a confirmation that the silver squeeze movement had a major effect on the London OTC market. They admit it in their own paper, printed on their own website right here at lbma.org.uk. Okay, at the end of February 2021, 765 million ounces was allocated in London against ETPs, leaving 360 million ounces of potentially available metal. Potentially, meaning lots of potential trade on there. And actually, some of it could be privately held, but we won't get into that. This suggests that had demand in iShares, that's the SLV, continued at the frenetic rate of late January, early February. Remember, 3 days where 110 million moved into SLV in 3 days due to demand from the social media storm, the silver squeeze movement. It would have only been a matter of weeks before London's existing stock was used up. So they had 110 million taken off, 360 million left over. Actually, I would say it'd be about 9 days, 9 or 10 days, not 2 weeks, be 9 or 10 business days. Because 110 million in 3 days, if that pace had kept up, it's going to eat up another 360 million in about 9 to 10 more days. While it would have been surprising to see ETP demand maintain this pace of buying, the concerns were still very real. This reflects both the time required for a refinery to convert non-good delivery material to 1,000-ounce bars. In other words, the London market is unallocated, and they're counting on forward production to meet current demand. That's what unallocated means. It means you don't have it now. You're playing the market like the EFP mechanism, COMEX, getting exposure to London market. It's all paper. But when you actually get down to demanding the physical, they don't have a lot. And that's the astounding revelation and admission in this paper. It is just astounding. We could go down and cover a lot of more things. I want to cover the social media storm here. The events of late January, early February have become almost folklore in the silver market. It is worth recalling how this emerged and its impact on retail buying even after the social media storm faded. In other words, they know that just because those 3 days have faded, the social media storm is there and it's getting stronger. All you have to do is go look at Reddit's Wall Street Silver channel and how many people they have and how popular that is. And then you see how many emails I get about it and how many comments on the shows I get about it and how many shows I'm getting invited to talk about it, how big this is, and it's not going away. It says, when the Reddit inspired, well, they go on to talk about GameStop and how this morphed into Wall Street Silver. I don't think it did. Wall Street Silver and Wall Street Bets being involved in GameStop and AMC and all those others, stocks, non-precious metal stocks, are completely different entities. So they're comparing Wall Street Bets and Wall Street Silver. That's not an apt comparison. Two separate groups of people, and I just want to point that out. So they talk about, as we get further into the paper, they talk about conspiracies. So buoyed by this success, social media discussions soon focused on silver, and in particular, long-held conspiracies that financial institutions were holding significant short positions. It's a conspiracy that they're holding significant short positions. Well, let's look and see if that's a conspiracy. So this is the Commitment of Traders report from CFTC.gov, the regulator's website, and I'm looking at silver as of April 20th, 2021. These swap dealers, which are financial institutions, bullion banks, hold 27.8% of all the short positions on the COMEX market. 27.8. And then you have another 16.85% in the managed money, which again is a financial institution. Put those together and you have about 28.3, add 16, that's 44% held by financial institutions. 27.8 on the bullion banks, 16.5 in managed money. It's right here in the numbers. So let's go back and reread that sentence. Buoyed by the success, social media institutions soon focused on silver, and in particular, long-held conspiracies that financial institutions were holding significant short positions. Gee, I don't know. Let's look at publicly published data by the regulator of that market in the United States, authorized by the government to track this. And we see over 40% held by financial institutions, managed money institutions, and bullion bank swap dealers. They're all financial institutions. Almost half of the shorts are there. Is that a conspiracy? I think not. But let's look at the concentration. Oh, we go back to Nick Laird's site, concentration of traders in the CFTC COTS. We look at silver here, the largest 4 and 8 traders. Look at the amount in terms of the traders. Look at the number of contracts. Gold and silver, the two most concentrated short positions on the exchange. Gold and silver, the two most concentrated short positions on the exchange. Gold and silver, the two most concentrated short positions on the exchange. I don't know how many times I can show that to you. I don't know how many times I can pull it out on a COT chart. But ladies and gentlemen, this is not a conspiracy theory. It's in publicly provided data by the US government, regulatory agency CFTC, which is the one that manages this. So they go on to talk about conspiracies and blah, 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 and all that good stuff. At the end of the day, it's not a conspiracy. It's on government data. Again, CFTC report, cftc.gov, April 20th, 2021, silver. Okay, got it. I don't know how else to show that to you. Aggregated data in terms of number of contracts, gold and silver. Look at those positions, largest 4 and 8. I don't know. I don't know what else I could even show you there. Let's look at days of production. So US days of production adjusted by sector. So let's see if we can load that chart. Gold and silver, largest 4 and 8 traders. More than palladium, platinum, copper, crude oil, cocoa, coffee, cotton, sugar, corn, rough rice, soybean. What other commodities are there? Okay, long-held conspiracy. Let's look for conspiracy again. Long-held conspiracy, financial institutions were holding significant short positions. Gee, I don't know. Is that significant? It's so much higher in the precious metals than any other of the regular commodities traded on the exchange, as reported by the CFTC on their own damn report. So Lbma, how about you contact the CFTC and see if that's an actual conspiracy by the data published by the CFTC. All right. There's more in here. They go on to talk about exchange traded, the Efp crisis, and they go on to say that when there's a price differential, it sucked metal over to COMEX because it actually pulled metal. This actually proves my point that you can take delivery via EFP, or you can actually force metal to move via EFP. I've said many times, EFP is not just for price arbitrage, okay? EFP also can pull metal off of the London market, because when people get really long EFPs and COMEX, it pulls the metal. That's the net effect. They go on to talk about that in this report. As a result, both gold and silver traders are forced to buy back contracts. They cannot make delivery, and so EFP premiums on both metals jumped. For silver, EFP remained volatile. Following the late March, early April peaks, both EFPs remain elevated. Ongoing heightened risk concerns, reopened logistical companies, and so the metal came over. So the attraction to both gold and silver. Second, the attraction to deliver both gold and silver to COMEX depositories reflect the going arbitrage opportunity at the time. What I have said over and over and over and over again, when you have an arbitrage opportunity between the two markets, yes, you can actually pull physical silver. The Lbma, which manages the London side of that EFP contract, is admitting it in this sentence I have highlighted on the report on their website. Not conspiracy there either. All right, I've beaten that with a dead horse, but a lot of you wanted to understand how EFP worked. I gave you the data. There we go, and I've given you the statistics. Now, I want to get something super interesting. We want to get into the regulator and some of the legalities, because this has come up in some private topics of conversation. There's one gentleman, very well, somewhat prominent in the space, has a prominent position anyway, but maybe not as well respected as he believes himself to be, who has made some disparaging comments on his channel. I'm not even going to edify those and tell you where they are. Feel free to go find them. But basically saying, we have another conspiracy theory that I'm saying that the CFTC Commissioner Rostin Benham didn't say what I said he said, and what I talked about last Sunday about them controlling the price and volume of silver last February, as we had the SilverSqueeze movement and the rush into the SLV, and therefore the aforementioned pool of the metals out of unallocated to allocated. I showed you earlier in this very presentation. So I'm going to play the section where Rostin Benham on video, in his own words, at the Boca V conference, the FIA, okay, International Futures Conference, says that exact thing and says more astounding things. I'm just going to play this for you. Actually, what I have to do is I have to share with sound. So let me reshare this with sound so that you guys can hear it. There we go. We're going to share with sound and listen to what the CFTC Acting Chairman Commodity Futures Trading Commission, Rostin Benham, says to moderator Walt Lucan at the Boca V conference, sponsored by, oh, I don't know, CME Group and these other entities. Hint, hint, hint. All right, let's listen.
See, Yeah, thanks, Walt. It's a great question. It's something that I've been thinking about, and the events around the silver markets happened shortly after I took over. I think in late January, and I think it's important to distinguish what an equity space with what happened in our markets, in the future space, specifically with the silver contract. And in many respects, the resiliency and the market structure of the futures market really were able to tamp down what could have been a much worse situation in the silver markets. And
so the infrastructure of the markets tamped down what could have been a worse situation in silver. What was the situation? Metal was being pulled from unallocated in London to SLV into an allocated state, threatening to bankrupt the London OTC market, getting close by the Lbma's own admission, and the price was getting close to $30. That's what the tamping down was. The market tools, which he'll talk about here in a moment, that the CFTC has and the exchange has, were to tamp down the movement of those metals and the price rise. Listen further.
Just pointing to a couple things that I've observed over the past couple of weeks, and I shared with my colleagues within the U.S. government, and that are either unique to many respects to the equity space entirely. We have sort of history and precedent in the futures space. We have a match order book, don't have rules. We have T+1 settlement. The clearing infrastructure as a general matter historically within the futures space is built in and very strong. Initial margin, daily mark to market, position limits. All of these things together, I think, really were very effective in managing what was at some point in those few days in late January, potentially a challenging situation, and give credit to the exchange for utilizing its authority and some of the tools it has within the margin space to control the sort of the price and the volatility of the silver contracts. But I think...
Okay, he just said the exchange controlled the price and volatility of the silver contracts. In other words, the exchange used all those market tools he just said that they had to control the price, the volatility, the volume of those trades on the exchange. Is that not intervention by the regulator? That's intervention by the regulator admitted by CFTC Chairman Rostin Benham.
All those things together are important elements of markets that both sort of, transparency, resiliency, credibility, as we talked about in the sustainability space, that make our markets very, very resilient and strong. And
so notice all the buzzwords he used there: transparency, credibility, sustainability. What does a market intervention by the market regulator have to do with those? But see, guys, I think this is the way they think. I think they don't see the market as benefiting the individual trader. They see the market as benefiting, I don't know who, maybe those financial interests, as we see, that conspiracy theory around the financial interests who have these shorts, 44% shorts, according to the COT report, and the largest 4 and 8 traders in gold and silver. Silver was a market he was talking about. It has the largest 4 and 8 concentration. Those tools were to reduce volatility, control the price. Who had the biggest, the most to lose by that silver price rising? I don't know. Was it the largest 4 and 8 shorts, those financial institutions that the Lbma says is conspiracy theory, but the CFTC reports say is not? So those CFTC reports that this gentleman is the chairman of say that you have those concentrated short positions, and what he's saying is essentially we needed to control that, basically protect them. In other words, if you read between the lines, they needed to control that to protect the interests that are in the market, in particular the bigger interest. They're not looking at the little guy here. And I don't believe Mr. Benham believes he's doing anything wrong. I think he's doing what the market was set up for. It was set up for the paper trade to allow these financial institutions to trade, to arbitrage, to make money on this. It was not for the small guy. It was not for us who own silver or the farmer producing wheat or whatever the case may be. It's not for us. What he's saying here is this market's for the big guys and not the small guys. That's me reading into what he's saying, because I don't think that the guy would honestly come out with this admission on the public airwaves at an international public conference unless he believed what he was doing was legal, ethical, moral. I just don't think he would. I think his view of the market is much different than what we all view it in, and that's what I want to get into talking about. You can listen more to what CFTC Chairman Rostin Benham says, but I think it's clear just from that excerpt what the gentleman believes and how the market makers see you and me. So if you expect as an individual trader, even if you're a farmer, if you're a producer or a merchant, one of those small guys, right? Maybe some of the other reportables that people trade in the market that are maybe individually well-to-do, but they're individuals, that market ain't for you, it's for them. And that's why they used all their market tools, like he said, to control the price and the volatility. Because who would the volatility have hurt? Gee, I don't know. Would it have been the largest 4 and 8 traders in the silver market, which are, according to the CFTC COT report, the financial institutions, which you can see right here, that belong, the swap dealers, which have 27.8% of the shorts, the managed money, such as hedge funds and others, have 16.5. Together, concentrated 4 and 8 have almost 40% of the short positions. That's who he's protecting. That's who he believes he needs to protect the integrity, the transparency of that market. That's why you use those buzzwords. So just want to show you who this market's for and what the CFTC is regulating and who they're here for, okay? And what they're here for. They're here to ensure that those financial institutions get what they want out of the market, and they smooth the price and get rid of the volatility and use other market tools to do that. If us retail traders, enthusiasts, and people who own, in small little amounts, and there are millions of us, actually want fair price discovery. That's what he's saying. And that I found to be an astounding admission for 2 reasons. One, that he actually said it, but 2, he doesn't have the cognizance to understand how that's going to appear to the many. Yeah, I mean, I'm sure it's music to the ears of financial institutions and the government, which he said he had been addressing during this whole SilverSqueeze movement. But that's the government and financial institutions. The markets are supposed to be here for us. This is a republic. And, the law is supposed to protect the individual. That's what a republic is, not the large financial institutions. So I just want to make that point. We're going to get into some legalities here because there is this insinuation from certain people in the market. By the way, one of them, which has sponsored this conference, and may happen to have their name down here. I'm not going to tell you which one, and some others that don't have their name down here. Insinuation that, gee, I don't know, that the SilverSqueeze movement, the small retailers, the enthusiasts, are into the market because and into the market and then potentially manipulate it, and they're the enemy. I want to address that a couple of ways. One, I've written in financial media for about 12 years. I was on Seeking Alpha. I was syndicated across a lot of major outlets: Yahoo Finance, Financial Sense, Talk Markets, NASDAQ.com, MarketWatch.com, many others where I got invited to or my information was syndicated. And the whole purpose of those websites is to talk about what you believe in, what you like, what you're enthusiast in, what you analyze. And everybody has their sort of fields, right? And we talk about stock portfolio allocations, and we talk about the Apple fanboys, and we talk about people who love Tesla or hate Tesla. That drives the entire financial industry in the United States and across the world. So to say that people getting together liking silver on a Reddit page is any different than that, which drives the entire financial sector, is utter bullshit. Okay? It's utter bullshit. And that is not collusive market behavior because it goes on in every market every day, and they encourage it in those other markets, just not gold or silver. Why? Because you have these traders short silver and gold, largest 4 and 8 positions, and it may affect them. Okay, it has to do with them, not us. I want to make that point. All right, now getting on the legality. So in the Constitution, why is it important to have real price discovery for gold and silver? Well, I'm in the Constitution right here in archives.gov. Okay, that's a government website, the National Archives, archives.gov, straight from the government website. I pulled this one in particular on purpose. Section 10, no state shall enter into any treaty, alliance, or confederation, grant letters of marque, enterprisal, coin money, emit bills of credit, make anything, thing with a capital T, anything, but gold or silver, coin with a capital C, in tender with a capital T, in payment, capital P, of debts with a capital D. The capitalizations are legally significant because they come with very specific meanings. You don't coin anything other than gold and silver as money. And that's in the Constitution. And I don't care what law you pass, the Federal Reserve, all that stuff. It's unconstitutional because Congress does not have the right, and the Supreme Court has said this, to vote a law in which contradicts a section of the Constitution, okay? And they also have limited ability to amend it to contradict a section of the Constitution. A lot of people don't know that. You can't just throw any amendment out there you want either. Congress doesn't have that power. The Supreme Court has said that over and over. And they're saying here in Section 10 No state, meaning the federal state, nor the states underneath it, the 50 states we now have in the union. That's what state means. If you look at the definitions of state in legal terms in this code, if you go to definitions, actually in the USC code, but that's also what they meant when they wrote it, because the founders wrote papers, and that's what they meant by state. They meant the federal and the state level. Okay. No state should make anything but gold and silver coin a tender and payment of debts. Okay. Period. Okay. So that's why gold and silver are important. And that's why when you have a fiat currency, you see the biggest concentrated 8 and 4 traders in gold and silver, because according to the Constitution, that's true money. And when you have this gentleman from the CFTC admitting that they used all their market tools to smooth volatility, cap the price of silver as it was moving up, and control the trade, in his own words at an international conference, that becomes unlawful in constitutional terms. Now, I don't believe the gentleman did this on purpose. I'm not trying to say he's knowingly a criminal. What I'm trying to say is I don't think he understands that, because he's grown up in a world that's based upon all the statutory law that's lost sight of this Constitution and the importance of gold and silver, and has lost sight of the fact that we really need free markets, not controlled markets. Even though he believes he's doing it for good reasons, I think he's lost his way, his understanding. So I want to make that clear. I'm not trying to say he's trying to do something illegal. And I made this point on Dunnigan's program, which you'll see hopefully on Friday when it comes out. I think they think they're doing the right thing. But I think in reality, if you look at the law, it's unlawful. All right, now going to 7 U.S. Code 9 here on Cornell Law School, we want to talk about manipulation. Prohibition regarding manipulation and false information. And they're talking about commodities, because you see swaps, commodities, interstate commerce. Prohibition against manipulation. But I'm going to come down here to other manipulation, part 3, okay? In addition to prohibition in paragraph 1, which is the one we see here, where they're talking about swaps, contracts of sales, registered entities, all that stuff, and they're defining who people are, what a person is, what a commodity is, it says this: in addition, it shall be unlawful for any person. Gee, I don't know. Is Rostin Benham a person? I believe he's a person. It shall be unlawful for any person, directly or indirectly, to manipulate or attempt to manipulate the price of any swap or of any commodity in interstate commerce, or for future delivery on a subject to the rules of any registered entity. Okay, now, if you're the CFTC commissioner and you're using market tools to do this, and the people under you are using market tools to do this, okay, is that a person? Yes. Are they covered here? Yes, because they're the regulator. And is that person in that concentration of people running the regulator with all these tools that the rest of us don't have, do they have more power to manipulate? Do they have more ability to manipulate? Do they have all these tools that he said he used to manipulate? Do they have more tools? Yeah. I can't use position limits. I can't enforce position limits as an individual trader. I can't do that. Even if all of Wall Street people, Silver's people got together, we can't overrule the exchange and the CFTC regulators on use of position limits and all of those things that he talked about, all those tools. We don't have that right. How would we manipulate the market? They've got all the tools to manipulate the market. And this gentleman just said in the video, that's exactly what they did. Okay. So that manipulation, you know, whether intentional or not, lawfully, you know, not only is it illegal according to the Constitution because it's money and you're not supposed to do that, but it's specified right here in 7 U.S. Code 9, right here on the Cornell Law website, right there. Okay. And right here in section 3, it should be unlawful for any person directly or indirectly to manipulate or attempt to manipulate the price of any swap or of any commodity. Rostin just admitted doing that. I don't think he understands this, and he's the head of the CFTC. And that's just astounding. How do these people get to the head? So let's talk about what is manipulation. Could, you know, is our enthusiasm, by the way, which goes on in every market, Tesla, Apple, your favorite car, your favorite sports team, because you like bonds, because you like a specific commodity, goes on in every market. Is that enthusiasm and that grassroots effort manipulative? Well, let's look at the definition of manipulate. So manipulate, to handle or control, typically in a skillful manner. Where the retail traders are the least skillful because we don't even trade on the exchange. We're not the big houses, and we're not protected by rules and tools promulgated by the CFTC. So we don't have those tools. The CFTC has the tools and the mechanisms. We don't have the tools, okay? The second definition, to control or influence a person or situation cleverly, unfairly, or unscrupulously. Were we controlling the situation individually? No. As a group, were we controlling it? I would say there was demand, but was it done unfairly? No, we used the market mechanism. They used SLV, which is promulgated, okay, for the purposes of giving a derivative exposure in a fund format to silver And SLV had to buy the silver ounces because that's what the prospectus said. There's nothing unfair about that. And it's not unscrupulous. Why? Because I'm going to read for you the definition of unscrupulous. In a way that does not show moral principles or is not honest or fair. How is it not fair? They just bought shares of SLV. They're in the public. You can create as many shares of SLV you want. It's not a closed-end fund. And they don't say how much you can or can't. There was no violation of how the SLV worked, because if there was, the SLV would have stopped it and said that's an illegal trade, or it goes against our rules, maybe not illegal, but it goes against our rules set about in our prospectus and in our policy documentation. So no, it was a bunch of little people saying, we want to buy silver because we believe in silver. Why? Because it's money according to the Constitution. It's money. It represents real value. It's lawful to go buy as much gold and silver as you want and can afford because it's money. So what legal precedents would anyone have for saying that the Wall Street silver movement, the Redditors, the silver squeezers, or anybody, including me or anybody else, is violating law and buying the SLV and buying a silver physical ounce and buying a silver stock, or any other way in which we choose to participate as individuals? Because if you made that stretch of an argument, you would have to say anybody that bought Tesla or anybody that bought Apple could be accused of manipulating Tesla and Apple, or anybody that bought Microsoft could be accused of manipulating Microsoft, or anybody who just went and bought wheat and created excess demand for wheat because they wanted to feed their family was unscrupulously affecting the market and had intent to do that, according to the law here at 7 US 9 on Cornell Law's website. I wanted to get in the legalities, because people who say it's unethical for people to do things like SilverSqueeze, that means it's unethical for you to tell anybody else that you like Tesla and to unduly influence them and to build a community. You know, and at what point does that stop? What about the value of sports franchises? If you like the Dallas Cowboys, I happen to live in Dallas, and all of my friends get together and we watch the game, we wear our gear and all that stuff, and it causes the value of the Dallas Cowboys to go up to $2 billion. Is that unfair to the rest of the teams? No, that's how it works. That's what they want. That's how all the financial markets work. I don't care how you do it. Okay. There's nothing unfair or unscrupulous about that. So I've gone on a little bit of a rant here at the end because I wanted to talk legalities. I wanted to show you legal proof according to the government's own websites. And I also wanted to show the statement by CFTC commissioner to show that if anybody had the tools to manipulate and do it cleverly and ability to affect the market, it would be them, not us. The individual can't, even if we wanted to. Now, if we do it in mass because we believe in it, that's okay. But that's what people do across the financial sector. It's called demand. It's called aggregate demand. It's economics. Okay. When people see their money printed to oblivion, okay, and they see the value dropping, they're going to put money in things that matter. Now, is it manipulative in gold? Only 0.5% of people in the US, according to statistics I see quoted every day, own gold in physical form. How could you possibly say that the individual investor was manipulating gold? Okay. And they don't have the size to get on the exchange markets and buy the 100-ounce gold bars or the 5,000-ounce silver bars. We don't have the money to do that. And if you're just buying a few shares at SLV and a lot of people are doing that, how is that unscrupulous? How is that using a tool? You're not using a tool. You're using the market mechanism that has been put forth as the legal market mechanism. No, it's really sour grapes because people are using market mechanisms to build their positions and to hedge the government printing of money and things that they see are problematic and to make investments. They're using the tools put before them to say that are legal and ethical to do that. And it's the people that have those tools at the top, like the CFTC, the CME group, and others that run the exchanges, or the financial institutions that have those large concentrated positions, which have the ability to manipulate. It ain't us. So if you're going to come after us, I've set the legal precedents to defeat that argument. I did it on purpose. If anybody calls me, I'm just going to point into this video and say, I'd like to see you, try to prosecute. And the reason I do that is because the CFTC has issued a press report in which they're stating that they're watching the retail traders for the potential of some sort of market malfeasance or manipulation. That's what they said in their words. And I think I've showed that release in previous videos, but you can just go to Google CFTC and you'll see it. I think they released it, it was sometime after the run up in silver in February. After, by the way, the CFTC controlled the price, the volatility, and the volume on COMEX, as per Rostin Benham, admitted in public on that video, can't take it back. I've now got it video here, can't take that one back. He just admitted. And he said, oh, I was talking with the government about what we did, to explain how we controlled that market. Okay. Why would you control silver? Constitution, it's money. It damages the credibility of the fiat dollar system and of our current financial system. Now, if the fiat dollar dies, could that cause a lot of pain for people? Yeah, but fiat currencies die all the time. That's the history of fiat currencies. It doesn't mean that you go persecute the small guy for trying to turn his declining, horribly valued dollar that's more and more worthless every single day for something of actual value, and gets tired of you manipulating that darn market, you know, to affect the value that he has in constitutional money. And the only thing that they can go to when you print so many dollars in the government, that you drive them out of anything else. Okay. All right. I'm going to stop it there. This has been a long video. This is leading up to the 10th anniversary of the May Day massacre in Silver. We're going to come back Saturday. We're going to do a live. I'll go as long as I can there, giving coverage. I wanted to do this for Silver. It's not because I'm trying to manipulate the market or get everybody to do something unscrupulous. We're doing it because we want you guys to have the information. We support it. But again, there's only a small percentage of us across the world that actually invest in the metals. Is not collusive. It can't be. We don't have the power of the market makers. We don't have the power of the market regulators. They have the power. We're just trying to put our money into something honest using legal tools that have been set up for us. And if you don't like that, then I guess you have to go to Congress and make it all legal. Just make the whole complex of trading on silver or gold illegal, make the EFPs illegal, make it all legal. Because that's the only way you have a standing lawful argument that we're doing anything wrong. And I think it's the reverse. And I wish people like Lbma, who I know means well in his way, in the way that he was taught the markets, I wish he would realize we're a republic. We protect the rights of the small guy. Gold and silver is constitutional money. The fiat dollar is dying. Stop hurting people by manipulating those markets. I know he's not doing it on purpose, but you got to realize and you got to stop. I hope he sees this video. I hope he realizes our perspective, because we matter. We're why the government is here. Okay, it's us, we the people. That's the way the Constitution starts. We the people, not you, the CFTC, not you, CME Group. Okay, not you, the exchanges, not you, the big financial centers. We the people. All right, we the people. All right, that has been the May Day Massacre special. Silver's being ripped off the COMEX. It almost got completely ripped off the Lbma, the actual physical. We'll see what happens when May occurs. And it's the whale is going to be the people, we the people. It's going to be the retail investment that says we want a little bit of silver and gold. And it ain't going to take a lot of us, because there ain't a lot of it around. And that's why it's super valuable. It's not going to be 95% of us all colluding to break the market. We'll be lucky if we move from 0.5% of investors in the US to 0.6. And that could bankrupt the system. That's how little actual metal there is. And that tells you everything you need to know about the value of gold and silver against the value of everything else, stocks, Bitcoin, the dollar, the debt, all of it. That should tell you everything you need to know. All right, till next time, this has been Rob with Gold Silver Pros. Thank you for joining my channel. Oh, by the way, hit like and subscribe. Go to the website. If you subscribe there to our subscription content, you get the Golden Quarterly, you get the Gold Silver Pros University, you get a copy of my book, the calculators, and lots more. And we support you there as well if you're interested. Thank you so much, guys. Till next time, this is Rob.